Good afternoon. It is Friday, December 15th, 4:05 p.m. Markets just closed. I don't know if we are truly in the mania phase right now. Any excuse to rally, stocks are finding. Right now, everybody is just popping the champagne that we're going to have this tax reform bill. Looks like it's going to pass. I haven't weighed in on it yet because I said it's been a very volatile, just a fluid situation. So we didn't know if we were going to get it. We didn't know what it would be like. So why talk about it? What I do want to talk about, people, is this yield curve. Because, don't look over here, look over there. All right? Sleight of hand, right? But this yield curve continues to flatten. And I printed out this chart again. Look at this. That was yesterday. This is today. The spread on the 2s against the 30. Yesterday it was 0.908. Today it's 0.855. The 2s against 10s. 2.54 yesterday, 2.521 today. Look at the 5s. The 5s against 30s. 0.586 yesterday, 0.534 today. Look at the 10s against 30. 0.368 yesterday, 0.334 today. So this is getting flatter and flatter and flatter. Now, the other day, I read the transcript from the FOMC meeting, and I kind of just hit the highlights. There was a lot to talk about. I want to zoom in on that one question that I really rushed through, all right? And it was like the final question about this yield curve. It was from Michael McKee of Bloomberg Television and Radio. And he says, I suppose I should be asking you a valedictory question, since it's the last question. But I don't think you can top what you've already said. So let me just do a couple of cleanup questions. This is no cleanup question. President Trump, while you were speaking, just said that he thinks his tax plan will produce 4% growth. Do you think that is possible? I'm not going to address that question. Second, do you think that there is any Fed blame or complicity in the flattening of the yield curve? And are you worried that there might be some sort of policy mistake built into that could slow the economy? And the last question, which is a bit of a valedictory, is one that everybody on Wall Street has wanted to ask you for 4 years. Since this is your last press conference, can you tell us which dot is yours? I'm not going to address that either. Chair Yellen. Well, I can answer the last question first. The answer is no. I've never been willing to reveal which dot is mine. And I'm not going to change that now. So you know my assessment, and I think most participants' assessments, as I have said, of the impact of the tax policy on growth has been informed by work by the Joint Committee on Taxation and other analysts. And everyone recognizes that there's uncertainty about the economic effects would be. And I wouldn't want to rule anything out. It is challenging, however, to achieve growth of the levels that you mentioned, blah, 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 blah. Now, she says, let's see. I think you also then asked me about the yield curve. The last question. Here it comes. Okay? And I mean, there is much discussion about yield curve inversions and whether or not a flattening yield curve could signal a recession. Is that the brunt of your question? And then he replies, and whether the Fed has made, if there's a policy mistake embedded in that. Did the Fed screw up with this yield curve? with all this QE and bond buying and being so behind on the curve. So this is her response, which is you really gotta like. So this is something that we discussed and have looked at. The yield curve has flattened some as we have raised short rates. They're raising the short rates, right? That flattens out the yield curve, all right? Because they're boxed in, okay? And they have to raise the short rates so they could have cushion to drop them again when the next recession comes. And they've created these asset bubbles in real estate, in stocks, in bonds, in you name it, in art, in collectible cars, sports memorabilia. It doesn't matter. Everything is a bubble. Bitcoin, cryptocurrencies, except gold and silver. Mainly the flattening yield curve mainly reflects higher short-term rates. The yield curve is not currently inverted, and I would say that the current slope is well within its historical range. Now, there is a strong correlation historically between yield curve inversions and recessions. There's a strong correlation historically between yield curve inversions and recessions. But let me emphasize that correlation is not causation, and I think that there are good reasons to think that the relationship between the slope of the yield curve and the business cycle may have changed. This time, it's different, okay? We can't look at the yield curve anymore, right, to determine where we are in the business cycle, right? It's different this time. It's like, remember the new economy, right? Earnings don't matter, right? Just eyeballs on the screen. How many clicks? That's all. It doesn't matter. We don't have a business model. We don't generate, earnings. But someday off in the future we will. The new economy. So this is the new yield curve. It no longer matters, right? And one reason for that is meaning that there's no longer, we can't necessarily assume yield curve will mean recession, right? And one reason for that is that long-term interest rates generally embody two factors, the long-term end of the curve. Two factors driving that. One is the expected average value of short rates over, say, 10 years. So what's the average over 10 years of the short end, right? And the second piece of it is the so-called term premium that often reflects things like inflation. In a normal economy, people, the yield curve should be sloping upward. The longer you go out on the curve, right, the more you should be compensated. If you're expecting in the future to get growth and inflation, the yield should be higher as you go out. That's the premium, not to mention the risk of going out longer, the uncertainties. So the longer you go out on the curve, right, the longer the duration, the higher the yield, and the higher the risk. So she's saying two reasons: the average of the short rate over, let's say, 10 years, and the premium built in for going out long. Typically, the term premium historically has been positive. It's been positive, right? Growth, inflation, right? So they're not getting the inflation. There's no growth. There's a complete disconnect here between what stocks are doing and what the bonds are doing here, this yield curve. So when the yield curve has inverted historically, it meant that short-term rates were well above expected short rates over the long term. So in the past, when the yield curve inflated, it was because the short rates were much higher because they were in this tightening cycle, right? The days of Paul Volcker, I suppose, right? The hawks, right? And the doves. There's no more hawks at the Fed. You have doves and uber doves. That's it, okay? It meant that short-term rates were well above average expected short rates over the longer run. So with the positive term premium, That's what it means. So in other words, in the past, you could have that positive term premium on the long, but the shorts were very high because they were really fighting inflation, and we were in a very restrictive monetary policy, right? And typically that means that monetary policy is restrictive, sometimes quite restrictive, and some of those recessions were situations in which the Fed was consciously tightening monetary policy because inflation was high and trying to slow the economy. So we're not doing that now. We're still accommodative. Well, right now the term premium is estimated to be quite low, but now it's the opposite. Why is it so low, people? Because there's no growth, there's no inflation, they can't get it. That's why the long end is low, this premium, right? So they're nudging up the short end, and the long end isn't going up. It's quite low, close to zero. And that means that structurally, as this can be true going forward, that the yield curve is likely to be flatter than it's been in the past. And so it could more easily invert if the Fed were to even move to a slightly restrictive policy. Even if it's slightly restrictive, their policy stance, you could see an inversion with a zero premium. They're in trouble, people. They're in big time trouble. Because if they don't raise rates, okay, meaningful, okay, we're looking, okay, at asset prices that are just going to be in complete bubble territory, right? Runaway inflation, hyperinflation. So I think the fact the term premium is so low and the yield curve generally is flatter is an important factor to consider. Now, I think it's also important to realize that market participants are not expressing heightened concern about the decline of the term premium. They don't care. There's no growth. They can't getting the inflation, supposedly, right? And when asked directly about the odds of a recession, they see it as low. And I would concur with that judgment. There's no red lights, there's no green lights, there's no yellow lights. It's full speed ahead. Now, I want to show you this chart. Every recession since 1970 has been preceded by an inverted yield curve. But this time we're told it's different. 1970. Right? The date of the inversion, it started in December 68. The date of the recession, January 70. Right? So let's call it 13 months. Right. Time from inversion to recession. And 13 months later, the yield curve inverted. 13 months later, there was a recession. Okay? The inversion lasted 15 months, and the recession lasted 11 months. 1974 recession. The inversion started in June of 73. The recession started December of 73. Right? 6 months later. The inversion lasted 18 months. The recession 16 months. The next recession was 1980. The inversion started November 78, 1980, November 78. The recession started February 1980. Took 15 months from the inversion to the recession. The inversion lasted 18 months. The recession, 6 months. 1981, then we had another one right after that, 1981 to 1982. The inversion started October 80, the recession August 81. Time from inversion to recession, 10 months. Inversion lasted 12 months. The recession started 16 months. which is quite interesting. Because that 80 recession was only 6 months long. Would you say that 80 recession was 6 months long, or it really didn't end? Then we get the 1990 recession. The inversion started June of 89. The recession started August of 90. Time from inversion to recession, 9 months. Duration of inversion, 7 months. Duration of recession, 8 months. Then we get the 2008-2009 recession, the Great Recession, which I believe was a depression, and I don't believe it's even over. Okay? The date the inversion started, August 6th. Okay? The date the recession started, January 8th. Time from inversion to recession was 17 months. The yield curve inverted in August of 06. Took 17 months for the recession to come January of 08. The inversion lasted 10 months and the recession 18 months. Okay, every single time since 1970 that we've had an inverted yield curve, we've had a depression, a recession that followed. And on average, it came 12 months later. That's why the other day, but stocks are going up. Stocks are going up, right? Because, there's no inversion now. So, it could take, even if it was inverted today, it could still take a year before we get a recession. So, it's smooth sailing, people, right? On average, the inversion lasts 12 months a year, and the recession, on average, lasts 12 months a year. And I think, 70, we got one in 74, 4 years later. 80, 6 years later. 81, just a year later. 90, 9 years later. From 1990 to 2001, 11 years. 2001 to 2008, 7 years. It's been 8 years. We're due. So, this looks where we're headed, okay? I saw this article too. I want to be brief, people. I know this video is getting long. A flattening yield curve has been a reliable leading indicator of past economic slowdowns, but this time around may be different. Unbelievable. People, put that image in your brain, okay? Put that image in your brain, all right? Stamp that on your brain. So when these carnival barkers, okay, and these P.T. Barnums show up, okay, and they want us, I told you that that story, right, with Damon Runyon, son, one of these days a man is going to approach you and he's going to want to bet you that he can, he can make the Jack of Spades come out of a brand new deck of cards and squirt cider in your left ear. Don't bet him, because you'll only get an ear full of cider. This is cider, people. A flattening yield curve has been a reliable leading indicator of past economic slowdowns, but this time around may be different. Aubrey explains. So there you go, people. I won't even bother to read it, but he comes up with this litany of reasons why this time it's different. It's not different, okay? Anyway, that's about it for today. Gold up slightly on the day. Maybe this was sell the rumor, buy the fact, and perhaps the opposite might be true with stocks. Maybe it was buy the rumor, in other words, this tax plan, and sell the fact. Remains to be seen. Beautiful day out today in the morning. It's very late fall in the northern hemisphere, but you can sense the change from the fall to the winter. Not so much about the temperature or the snow, but it's the air. There's some stillness in the air, that you can sense the change. Went out for a walk, good walk, nice and quiet and just peaceful. If you get an opportunity, get out, clear your head, renew your mind. Does wonders, spirit, soul, and body. Lord willing, we pick this up on Monday. Have a good weekend, people. Lot to talk about. We live in interesting times. Ciao.